Welcome to our 2022 webinar series, Risk Management with Insurance in a Post-Pandemic World. The COVID-19 pandemic taught us to adapt and accelerate trends socially, technically, and environmentally. As we inch into a post-pandemic world, risk management continues to be a top of mind for most of us. Each month, you'll learn about insurance solutions you and your clients can consider, plus the significant impact to insurers and their post-pandemic strategies. Each webinar will last about 50 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. Today's presenter joined LLIS in 2003, assumed the role of president in 2008, and CEO in January of 2013. He continues to monitor the insurance and financial services industry to provide you and your clients are getting the most up-to-date recommendations. Here to present is Mark Maurer.
Thank you, Claudia. Thank you to everybody for tuning in today. And as the David Bowie song goes, changes. And nothing changes like client situations and their needs for insurance, especially life insurance and disability coverage. And so today we're going to look at different times when we've reviewed clients' policies and other times to think about when is a good time to bring this up with your clients or ask us about it. And of course, you have two different types of clients, new clients and existing clients. And many times, new clients sign on with you and they bring you a whole bunch of policies. Here's what I have. So we look at it from almost the beginning of their planning journey with you. And then you have existing clients who you may have been working with for years, and one day show up with a couple whole life policies or a few annuities and say, what do you think about these? Just remember, ask Mark, ask LLIS to help with those policy reviews for you. And then we're going to talk about conversions. So sometimes with policy reviews, we look at applying for new policies, and that assumes clients are healthy and able to get new coverage. Sometimes we have those changes, and it's a conversion where maybe a client isn't in good health. What do we do with those policies, those term policies, as an option if their health isn't as good anymore? So how many of you have ever done this? I know I have. Ooh, if I just buy $3 more worth of something, I can move from the 15% discount to the 20% discount. It'll get me from my $87 to over $100. So what do? You buy an extra pair of socks that you don't really need, or you buy 5 boxes of granola bars instead of the 3 that you really wanted. So sometimes it's good. Granola bars, I'm going to eat 3 boxes or 5 boxes. That extra pair of socks, maybe I didn't really need it. But by bundling or getting multiples of something, sometimes there's some cost savings. Other times, you end up paying $12 for a pair of socks that you didn't really need to save $8, but you feel better about it. So maybe it doesn't always work out well. So here's a situation of new clients. Holly and Andrew, 34 and 35, started working with their fee-only advisor, and their advisor asked me to review their existing life insurance policies. They'd purchased these policies in 2021. They were $1 million 30-year term policies each. Andrew was paying $167 per month, and Holly was paying $94 per month. So talking with the advisor about the clients as part of the just general fact gathering, what do they need? How much do they need? Tell me about these policies. The advisor said they bundled umbrella, home, auto, etc. as far as getting these policies. So they have at least 4 policies, or now 5, 2 term policies. So 5 term policies, 5 different insurance policies with this same particular insurance company. And the advisor said, well, they got the super preferred rate on these policies. So that's what the agent said they had on these policies were issued under. So when I see something like they bundled umbrella, home, and auto, it makes me think of the insurance people that you're probably the most familiar with from commercials. Jake or Drake, You have the Gecko, you have Flo, you have Mayhem, and J.K. Simmons. So I think he's got a name. On the commercials, I just like him. He's got a great voice. Those types of companies are primarily a property and casualty company, home insurance, auto insurance. So those are what they specialize in. And those are the types of policies that normally get the most benefits from bundling. If you get your home, auto, and umbrella with one company, it may save money on all three. The life insurance is usually something that, A, they don't specialize in, so the rates aren't going to be that great. And it may or may not actually have gotten a bundling discount and may have just been grouped in with everything as far as, oh, well, there's a bundling discount. Nobody ever said these do or these don't qualify for the discounts. So long story short, if you sort of recognize the insurance company pitch person, it's probably good auto, home, those types of things. But as far as life insurance goes, that's not going to be their primary where they're specializing, where they want to excel. And kind of factors in here. Holly, $1 million 30-year term policy, $94 a month at that super preferred plus, best rate class qualifier. Now a year later, so she's a year older and our insurance costs go up as we get older, just a little bit each year when we're in our 30s, but still go up. $1 million 30-year term policy for her at the preferred plus or best rate class, somewhere between $49 and $51 a month. She's paying $49 a month. So if that, or 94, if that $94 per month has a bundling discount in it, I'm not sure I would have wanted to see it without the bundling discount. So that shows me that this particular insurance company may be good at the home, auto, umbrella, but their life insurance is a very expensive add-on or almost an afterthought. New coverage today, actually almost half the cost per month. Andrew, $1 million 30-year term, paying $167 per month. At that super preferred best rate class, $64, $65 a month. So not quite a third of the cost, but less than half the cost. So it's an awful lot of coverage or an awful lot of premium for the same amount of coverage. The bundling may really have helped with the life insurance or had really helped with the auto insurance, the homeowner's insurance. The life insurance, much better. They can save about $100 a month by going somewhere else. And like I said, if this includes the bundle, it's still very expensive. Now, sometimes you have an idea and technically it can work, but it may not always be the best design or best idea of what's out there. So sometimes you might be able to put a flatbed trailer on the back of a Prius. The Prius is a motorized vehicle, so technically it would work. I just know if I'm going up a hill, I would not want to necessarily be behind this contraption that's going on. So it might be kind of right, but maybe there's a better way to do it. So here's David. He's male, age 42. He has a stable job with the local community college. Just got a raise from 85 to 96,000. His wife Denise stays home currently with his 4 girls. That's a lot of girls. I have 1. It's wonderful. 4, maybe there's a thing as too much wonderful, but good for him. What does he have for life insurance? He has one-time salary, employer provided group. So that's great. Somebody else is paying for one-time salary. Wonderful. Then he has a $211,000 whole life policy. And this policy is going to be paid up at age 65. He's paying $923 a year and has about $5,500 of cash surrender value. So like the Prius towing something, he has some life insurance, but it's not necessarily the ideal way to go about it. Because he has those 4 girls. Not only is he paying for 4 girls just to live, going to be planning for 4 weddings, 4 college tuitions. So right now, if he were to pass away, Denise gets that one-time salary and about $211,000 of whole life. So she's getting about 3 times his income. So I know that not a lot of people, when they're in their mid-40s, could do everything they wanted to do in life, or maybe even some of the things, with only 3 more years of income. Take it another way. Would you all say that David could retire in 3 years? I bet his financial planner said no. So that's sort of what we're looking at today. Whole life, little coverage for a long time, may not be the best fit right now. And partly it's just not enough. So idea number 1 was to look at more coverage. And instead of whole life, we're going to look at term coverage. $1 million of term for about 10 times his income. Some of my rules of thumb are at 10 times earnings when you have kids is a minimum. It may prevent catastrophe, but it's not going to necessarily allow Denise to live in the lifestyle that they have now. David probably is going to work another 20 years or maybe longer. So 10 times earnings might help pay off the mortgage, pay for some expenses for a while, but she may have to go back to work. There's other things that may have to happen, but it prevents them from losing a house, not being able to pay for groceries. Maybe the kids, they don't end up helping out or paying for college. The kids have to get scholarships or take out their own loans. So things happen with the $1 million that couldn't happen with just the 300,000, but it's still better to have that $1 million for the next. And I looked at a 25-year term to get the youngest into or out of college, depending on how long she stays in school. So at a preferred plus rate class, that's an $1,100 premium. Remember right now, for whole life, $211,000, he's paying about $900 and change. So at this point, we're increasing his annual premium, and with his income and the spouse who doesn't work and 4 kids, we don't necessarily want to add more to his insurance outflow. But we're really concerned about the amount of coverage he has while the kids are small. Once we put the coverage in place, then he can surrender the whole life policy for $5,500, which pays for about 5 years of that premium. Alternatively, we looked at a layer term layer. And this is something I really like doing. And so what we do is we match coverage amounts to meet his needs. We look another way. If his loss of income is his future income the same in 20 years as it is today? No, because in 20 years, he will have had 20 years of income behind him, 20 years of savings, 20 years of paying down the mortgage, 20 years of getting some kids into or out of school. So what we can do is layer multiple amounts of term and different term lengths. So this saves premiums both initially, and then we get some additional savings when some of these layers drop off. So we have some of these term lengths that correlate or correspond to specific life events. And once we hit those milestones and we get closer and closer to retirement, the potential income ahead of us is decreasing too. So one option I looked at, just nice round $500,000 20-year term and $500,000 25-year term. So for the next 20 years, he has both policies. $1 million in total coverage that gets the youngest into college. And then in 20 years, that $411 drops off, and he has $500,000 in coverage for 5 more years to get the youngest all the way out of college. And in 20 years, he's paying just $594 a year. So initially, we're paying much closer to the amount he's paying for his whole life coverage, 900 and change for 211,000. Now we're paying just over $1,000 for $1 million of coverage, and we've stacked it so that he has the most coverage when all the kids are small, and then decreasing as they go out of the house, become more self-sufficient, and hopefully get everybody through college. Now, for David, by layering the policies as compared to one policy for all years, initially it saves about 9%. So about $100. That's, still good. But the big savings really comes in the last years. Instead of still paying $1,100 for a policy, those last 5 years, the coverage drops, and now he's paying $600 a year. Yes, it's for less coverage, but over time, he's paying a little bit less in life insurance premiums that can be added to savings or college savings or all those different things. So I really like the layering approach here for David because he has a big need today when all the kids are little, and then it tears off or layers off over time. And let's not forget about Denise. She's a stay-at-home mom, and while she isn't earning an income, if something were to happen to her, if she weren't there, there are a lot of things that she does to keep everything running. And sometimes you see these. There's chauffeur, there's chef, there's accountant, there's all kinds of therapist, all the different things that she's going to be doing to make a house of 6 people and 4 little girls run. So if something happened to her, if she wasn't there tomorrow, it's probably unlikely that David could do what he's doing without any interruption and still make his full income without either making some changes or hiring some help. And maybe it's hiring a person for aftercare. Maybe it's adding a room onto the house so that grandma can come live with them. Don't know what those look like. But even though Denise were to pass away tomorrow, there's not a loss of income coming in, there would be a lot of additional expenses going out. And so when people ask me, there's a spouse, stay-at-home spouse, can they get life insurance? The answer is definitely yes. There's an economic impact to that household. And so what are some of the other things? Those really were just kind of clients bringing policies to you. So that's more of a sort of reactionary type of policy review. A new client coming on board, client saying, I've got these existing policies, but what are things that might have you, or client situations that might have you initiate a review of life insurance policies? New home, big new debt. That's one of the things that most people say they have life insurance for, to pay off debts, to be able to pay off my mortgage. New kids, absolutely. I think I've had 1 or 2 this week already of clients and advisors saying they had another child or had their first child, and we like to look at bumping up their life insurance. Big changes. Change in marital status. This can be getting married or getting unmarried. If you're unmarried, do you need to keep some life insurance for a divorce decree? If you got married, now do you have shared expenses, maybe shared kids, things that people who become reliant on you for your income? New employment, a raise, new job, which may actually go hand in hand with new home, because you get a nice new job, you buy a bigger house or your first house. A lot of these aren't isolated by themselves, but work hand in hand. Started or sold a business. Do I need the life insurance? I sold the business. Do I need to keep these life insurance policies anymore? I started a business. Do I need some key man coverage? Do I need some life insurance for buy, sell, or buyout coverage? Change in health. We're going to talk about this with conversions. If your health has declined, what if your health is better? Find out somebody quit smoking. Find out one of your clients quit smoking. Maybe we can improve their life insurance premiums. Retirement. Do they need the coverage at all anymore? Who's relying on that? If there's no income to replace, then what do we need to do? Do we even need those policies anymore? Death of a family member. This is less about the actual policies themselves, but how about beneficiaries? What if one of somebody's named beneficiaries is no longer living? Might be a time to review beneficiaries to make sure that things happen as the insured would want them to. Providing care or support to an aging parent. We think going through life that once our kids get out of the house, we're going to be footloose and fancy free like the two people there dancing on the beach in retirement. Last kids out of the house, off to college, woohoo, we're turning their rooms into a weight room and a scrapbooking room. Awesome. Well, it probably doesn't happen like that. And for a lot of people, now all of a sudden they have to care for a parent. Are they providing actual support, financial support? So maybe that life insurance need is still there because there's enough money for us to dance on the beach if nothing happens. But if mom or dad, now we're paying for mom and dad's care. Maybe they have a need to keep some life insurance for their care. Another type of policy review I do, think of it like the waffle maker. How many of you have ever gotten a really nice waffle maker? Maybe you got it for your wedding, maybe you got it for a Christmas present, and you said, I'm gonna make the heck out of some waffles. And you know what? We made waffles for five times, 10 times, maybe a month. You get that little book, you try all the different kinds of waffles. And then you know what happens? You get tired of cleaning the waffle maker. And you go, I only use this to make waffles. And I realized Saturday mornings I really kind of like to sleep or just sip coffee instead of cleaning waffle goo out of the waffle maker. So it goes into the back of the cabinet. Sounds good. Who wouldn't like nice hot waffles? I would. I could eat some right now. But do I really need it? Here's Benjamin. He's a male age 34. He has a $300,000 whole life policy. And the way this policy was designed was he was going to pay a $35,000 premium in year one, $15,000 to age 60, and $4,500 a year to age 100. And it was sold to him, presented, all of the cash value, retirement savings, investment components of whole life, permanent life insurance policies. That was really what he was, how the policy was presented to him. So when I looked at the illustration, and the non-guaranteed values also means the current value. So it's probably the best case scenario, at least for the short term. I thought, meh, it's okay. You know, in the first year, he'd put in $35,000 and his total cash value is going to be $29,000. That's not a gain by any stretch of the imagination. It's not just flat, but it's not horrible. I mean, I've seen worse. But there is no free lunch to life insurance. There are insurance expenses. It happens. They're in there. And so when I looked for a number of years, it takes 7 years to break even. So for the first 6 years, their best case scenario is a loss on cash values. Explained that way, I'm not sure how many people would actually do this. You fast forward to age 85 or 90 and everything looks great. But if we were to tell I'm going to, my best case is that you're going to have losses for the first 6 years. Might be longer than that. My best case is a loss for 6 years. Most people probably wouldn't do this. But he did. After 7 years, he'll have paid in $125,000 and there was a projection to have $127,000. So gains. First time there's gains. As just almost an aside, the issue date of this policy was March 13th, 2020. And I'm sure all of you can remember about You might have forgotten about it, but if you think about it for about 30 seconds, you remember March of 2020. The S&P index was at 2711. When I reviewed the policy earlier in the year, S&P was at 4525. So had he put that $35,000 into an S&P 500 fund, might have had a 27% increase or 72% increase by earlier this year instead of what's almost a guaranteed loss for a couple of years. Of course, that's hindsight. Who knew? But just interesting to look at it that way. And then, to me, I think it failed life insurance rule number 1, which is don't talk about Fight Club. No. Failed life insurance rule number 1 because there's no loss at his death. He has no spouse. He has no children. No student loans that his parents co-signed. There's no reason. No one has a loss at his death. His beneficiary is his brother. I love my brother. He's a great guy. Looks kind of like me. I'm lucky I still have a little bit more hair than he does. I love him, but I don't know that I'd put $35,000 into a life insurance policy to leave him $300,000. No, I'm sorry. I wouldn't. I don't know if I would. I wouldn't. So, but there's not a lot. There's not a true loss. Would it be nice to leave somebody something? Sure. But for this particular client, he's in a loss position. He's locked in a loss position for 6 years. He has insurance. He's paying for insurance expenses. And there's no reason for him to be paying for life insurance. We could consider future insurability. And when I ask things like, is he dating somebody? Is he going to get married? I get that a lot. He's engaged. He's going to get married. None of those things. And even if he'd wanted a final expense or burial policy, so that is maybe for his parents, so they could not have to pay for a funeral out of their own pocket, it could have been a much smaller policy. So to me, that's one of these, like the waffle maker, just doesn't really fit. Sometimes a policy review is like that key ring that we all have. All those keys that you go, I don't know what these are for anymore, but I can't throw them away because they may open something I need to get into one day, and I know right where it is. Sometimes it's like that. We collect them along the way. Here's Ruben, a male age 37 in Texas. In 2014, he bought a $900,000 20-year term, issued at Preferred Plus rates, paying $388. He has 12 years left. And a way to compare policies when we have different amounts is the cost per thousand. So he's paying 43 cents per thousand for this policy. In 2018, he collected another key, added another policy to that key ring, $100,000 ART, annual renewable term, and he purchased this through his lodge, paying $138, 1/3 the cost of the 20-year term for 1/9 the coverage, $1.38 per thousand. So we can see it's not a great policy. And when I mentioned this to them, as far as the expenses, it was more done for the lodge as part of just a benefit for them, being able to say we have 100% participation. So he wants to keep it. Fine. Small policy, $138 a year. We know we can do better elsewhere, but it's not breaking the bank. So we want to clean up the keys. His advisor wants to have $3 million layered through retirement. So we looked at a $1 million 10-year term policy, $250 a year. It's 25 cents per thousand. $100,000 20-year term, $430, 43 cents per thousand. Remember, for his $900,000 that has 12 years left, he's paying the same 43 cents per thousand. This is more. This policy goes longer, so this policy is a better deal. $1 million 30-year term, $840, which you can probably figure out the cost per thousand. So this way, he would have $3 million of coverage that gets his youngest to driving age. That 10-year policy drops off, $2 million for 10 more years to get everybody out of college, and then $1 million for 10 more years to get to retirement age. So what we'd end up doing is replacing, it's going to keep that $100,000 policy so that the lodge can have 100% participation, and replace that $900,000 policy because we can get a either 20-year term policy for the same cost per dollar, or shorter like a 10-year for much less per dollar of coverage. Now, sometimes when I do policy reviews, I come up with a win-win situation, and sometimes they're a win-win-win. And for Dr. White, it was pretty much a win-win-win. He's age 66, and he's approaching retirement in the next year or two, and has a $2.8 million group variable universal life policy. And I'm going to touch on how group VUL works just a moment. But $2.8 million of life insurance with $1 million cash value and a $500,000 cost basis. He has not much need for life insurance anymore. And so his goal or desire, or what he intended to do with this policy when he set it up however many years ago, was that he wants to use the cash value for retirement income. What is group VUL, group UL? Group, any type of permanent coverage. Instead of the traditional group term, an employer may offer group UL or group VUL. It's usually to higher income earning employees, so it may be some sort of carve out. It also, because he's a doctor, it might be something that was offered to all the doctors. There may be a physicians group and all of the physicians got these policies rather than the traditional group term. Like group term, the company is paying for the cost of insurance while the employee is working. So group term just has a cost every month. This has a cost every month. So similar there. But with the group VUL or UL, the employee can add more money into the policy each month, which grows on a tax deferred basis. Many times, so as I said before with one of the clients, there's no free lunch with life insurance. Well, this just made it a lot freer because usually you pay the premiums and then the cost of insurance come out of your cash values and your premiums. In this case, the employer is paying the premiums. So most of the money that Dr. White was putting into the policy is going into the cash values, which is then able to accumulate. So it becomes a much freer lunch, maybe a less costly lunch. Not quite free lunch, but much better. But then what happens is with the point in time that we're meeting with Dr. White. At retirement or separation, the employee gets the policy, they take over the policy on their own, but the company stops paying those costs of insurance or that minimum premium outlay if they've been paying them, which they have. So all of a sudden, the employer stops paying for the insurance charges. Somebody asked me, in reviewing permanent policies, how do you get the cost basis number? Is that in an illustration or do you have to ask for it separately? That is a number that the insurance company has to keep. So if a client surrenders a policy or transfers, they have to keep record of that in order to report any gains to the IRS. So it's not usually in the illustration. It's something you have to ask the insurance company directly for, and it would be just a dollar number, $500,000, $468,000, et cetera, but not normally in the illustration. So now that the client is separated, they're probably going to stop contributing to the policy because they're not earning an income. And now the policy is going to start taking cost of insurance out every year out of those cash values. And now that the clients are normally at retirement age, it's not an insignificant amount of expense either. So that's usually where we get involved because, as you'll see in a second, what happens. So here's Dr. White's illustration. So this was the most recent proposal that he'd gotten from the insurance provider. No future premiums. There's no money going in, no money coming out. Cash values increase for a little while, and then tops out about age 79 or 80. And then you can see at after a while, it starts to nosedive. Those costs of insurance really start eating into the policy, eating into those cash values, and it lapses about age 93 with no cash value. Lapses at age 93 with no cash value. What did he want to do with it? He wants to use it for income, right? Yes. That illustration just told me if he never took $1 out, it's going to lapse at age 93. So if he does take any money out, the policy falls apart even faster. So he won't get access to the full policy value. Right now, he may outlive it without taking out $1. So that's not a good idea. So what are options? Like Steve Miller Band said, go on, take the money and run. He could just cancel the policy. Surrender today, take the cash value. What's not ideal about that? $500,000 is tax-free return of premium, but the other $500,000 is taxed as ordinary income in the year he surrenders. So if that was this year, he would add $500,000 of taxable income to his earned income. So I'm going to say that's not desirable. If this was something, maybe the basis was much higher, it was much smaller gain, he may want to wait until the year he's retired, has no income, and then surrender the policy. Let's say the gain was only $50,000 on $1 million. Maybe you just owe tax on that the year or two after you retire and go buy a boat. Could look at transferring the cash values into an immediate annuity. Annuitize the cash values over a fixed period of time, like 5 years to 10 years, or his lifetime. Set it and forget it. Once the money goes in, there's a fixed payment for the specified number of years or lifetime. Simple. And while we spread out the tax, because each payment is part basis and part gains over his life expectancy or the fixed period of time, we can't avoid paying the taxes. Once we annuitize and do that immediate annuity, part of its gains, part of its basis. We could do a 1035 exchange to a deferred annuity. So we can continue the tax deferral, have lower expenses than the group VUL. So instead of it nosediving because of the life insurance expenses on that group VUL, probably keep growing. But one of the issues there is that annuity withdrawals are considered last in, first out. So when you start to take money out of an annuity, you're going to take your gains out first. So the first $500,000 he takes from that from that annuity is going to be taxed as ordinary income. And annuities don't have loan provisions. So we take out the least desirable income first with an annuity. Or we can do a 1035 exchange to an advisory life insurance policy. So how do we design this? With as small of a life insurance death benefit as we can get. 1.6 million instead of his current 2.8, because we want to minimize those life insurance expenses. He doesn't have much of a legacy need at all. Advisory life insurance policy has no surrender charges, so he has immediate access to those cash values. And by keeping the cash values in life insurance, keeping the money in life insurance, he's able to first take tax-free withdrawals up to the cost basis. Remember, with an annuity, you take the withdrawals of the gains out first. So we can take out tax-free withdrawals up to cost basis, tax-free loans against the gains, and as long as there's $1 in cash value at death, no tax is due at death at all. What's a cool thing about the advisory life insurance policy? Well, designed for field advisors to be able to assist in the investment allocation in the early years while it's growing. You're also around to help clients decide if they want, when it's the right time to take money out of this policy. Do we take some out of the IRA buckets, 401k buckets, brokerage accounts buckets, cash value of life insurance buckets? So you're around all those times. And so with the advisory life insurance policies, you can add the policy cash value to your AUM software for tracking, balancing, billing purposes. So a policy is really designed for field advisors to be able to assist their clients with policies like this. And so what did the new life insurance policy do with the illustration? Same assumptions as the group VUL, but the smaller death benefit projected he could take out $101,000 for 15 years. And at age 120 or 121, whatever policy maturity was, there was still a tiny little amount of cash value in the policy so that the policy didn't lapse. So he would have gotten out over $1.5 million without paying any taxes. So when I said win, 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 I think there's 3 or 4 wins in there. Now, I'm really a G.I. Joe man, but Transformers like Optimus Prime sometimes are just the coolest things. And we get to have some Transformers in life insurance too. Because sometimes we convert life insurance policies. So we transform existing term policies into permanent policies because normally the length of time that somebody needs a life insurance policy has changed. Conversion is a contractual right that allows you to exchange your term policy for permanent coverage with no underwriting. The magic is the no underwriting. A 40-year-old who bought a 20-year term policy, when they get to age 60, 20 years later, can convert their term policy as a 60-year-old, so it's a current age when you convert, but at the same health class they were issued 20 years ago. So if somebody started smoking, they convert as a non-smoker. Someone has heart attacks and smoking, they might be a rated smoker. If they applied for new coverage, they're still a preferred or non-smoker, whatever they got 20 years ago. So there's the real benefit to it. The value is that there's no underwriting. So if someone's not in as good health, there's value there in looking at that conversion. But there is a cutoff to conversion. It's usually the end of the term period or some specified age. Age 70 is most common. Few companies have 65. Few companies have maybe 10 years. And then 1 or 2 truly have a non-convertible term policy. But we're always looking at policies that have that earlier of term period to whatever the specified age is. So Stephen and Judy are approaching 70 and 55. Stephen was told he needs to keep some life insurance. Not by anybody else but Judy. Judy said, you need to keep some life insurance on you. And he had a $750,000 10-year term policy that he'd purchased in 2012. So he contacted us to say, what would conversion look like? He was preferred plus 10 years ago. And so in converting a $750,000 term policy for him, $33,000 per year. And this particular conversion policy is going to be an accumulation type policy. After 20 years, there's $558,000 of cash value. Now conversion, you're using it if you have insurance with XYZ company and you want to convert, it's to XYZ insurance company's policy or policies, whatever they allow conversion to. So at that point, there's only one company. Another thing we also look at is if somebody wants some permanent coverage, what if we did go through underwriting? Are there other options available? Because now there's lots of different insurance companies we can look at to see, does it make sense to apply? If somebody's still preferred or prefer plus, it's very likely that another insurance company's rate over here may be better than the one company who you happen to have the term policy with. So we have lots of different companies if we go through the underwriting. So we pre-qualified Stephen. Since that term policy, he's gotten some arthritis, some sleep apnea, had a bout of melanoma. Last 2 years, been having some anxiety and depression issues. So he's taken 2 medications. So best case scenarios, we're looking at standard non-smoker rates today. So here's that difference. Preferred plus on a conversion or standard today. And here's sort of how that shakes out. To convert, basically no questions. There's a little bit of paperwork. That's about all. And a check. $33,000 a year. A new policy, going through the application process, probably a paramed exam at his age, reviewing medical records, $28,000 for a no lapse guarantee type policy. So what's the difference here? The conversion is to a cash value type policy, and he'll have cash values growing every year. The GUL that he'd have to apply for is really like a lifetime term. There wasn't going to be hardly any cash value, but a lower premium. So there was sort of the decision tree we came to with Stephen, The new policy, even at standard rates, cost him a little bit less, but it was really like another term policy. And ultimately, he decided to convert. He liked the idea of that cash value there, but there wasn't just an obvious answer that conversion was better here for him. It's certain health issues or conditions may have been. So we went through the exercise to make sure that we were finding the best fit for him. Renee's 67. She wanted to leave a legacy for her son, had $1 million to age 75, which longer than she's expecting to live past that. And she's still pretty healthy. So she wanted to convert $200,000 of her policy to universal life. This is another thing that you can do with conversions. You don't have to convert the whole amount. Renee's going to convert $200,000 of that $1 million policy to permanent coverage, keep the rest as term. So this is kind of what her life insurance coverage looks like. For the next to age 79, she's still going to have $1 million between both policies. But then after age 79, that $200,000 all the way out to age 100. So if something happens to her between now and age 79, her son gets $1 million. But she wanted to make sure, even if I live past 79, I assume I'm sure planning on it. I think we'll be fine financially in all ways, but want to make sure that I'm still able to leave my son some money. And the last thing we're going to talk about are disability policies, keeping those current. And sometimes I think of disability policies like Legos or Duplos in this case. You get a policy, but then over time you can add to it, and you can keep stacking and stacking on top of different policies. Keep stacking policies on top of the original policies. There's two types of disability increases. One, automatic increase riders, and these are small. Normally you'd get a letter, client gets a letter every year. Hi, Mr. Client, you started with $5,000 a month of disability benefits because of your automatic increase rider, automatic benefit adjustment, whatever it might be. We're going to increase your policy by 3% a month, 4% a month. There's nothing you need to do, but if you don't want this, please let us know and we won't do it. So there's nothing to do. That $5,000 a month goes to $5,150 and then $5,400 the year after that. So just small automatic. So that's the key, is they're automatic, but they're small, but they're automatic. And one thing to know is that if you say no, I think you have to say, if you say no twice in a row, the insurance company stops offering these. And I'm not sure if it's in a row or cumulative, but think of it like asking somebody on a date or to a dance. You can ask them once, maybe they say no. You try again later, maybe it's a better time for them. When they say no the second time, probably time to stop. Future increase riders. Now these are going to be larger increases. So that's going to require some financial underwriting. It's going to require an application. So the insurance company at that point, if you say, I want to increase my coverage to $10,000 from $5,000 a month, they might say, sure, but I need to make sure that you're making enough that makes sense for us. But the important thing here is that there might be an application and there might be financial underwriting, but there's no medical underwriting. That's what makes future increase riders, benefit updates, future increase options, whatever they might be called. What makes both of these so valuable? The automatic, probably figured out with the fact that it's automatic that there's no underwriting. But here, we apply and request additional coverage, but there's not a health requirement, just a financial underwriting part. So very valuable, again, if client's health has changed. And depending on the insurance company, you have the option to increase it every year, every 3 years. You can choose the amount to increase. Some companies allow you to do maybe $250 a month as a minimum. Some companies might say you need to take 50% of what you're eligible for in order for us to increase it. But you can choose. You don't always, kind of like conversion, you don't always have to do the whole amount, but you may need to take some. So here's Kyle. He's male, age 28 in Ohio. In 2013, we helped him get some disability coverage. He was an executive recruiter, still is an executive recruiter, and he was making $63,000. And we helped him get a $3,550 monthly disability benefit policy, and it had a $6,450 future increase option pool. So that means between the $3,550 he has now and the $6,450, we could eventually increase his policy up to $10,000 a month based on financial underwriting with no new medical underwriting. So in 2015, we added a Lego. His income was $72,000, so we added $610 a month of benefits. So now he's got more benefits, and that future increase pool reduced. You see the 4160, 5840, again, still adds up to 10,000. So insurance company will issue up to 10,000 as we add base benefits, the future increase rider decreases. In 2018, we add another Lego. And he did well. 3 years and he more than doubled his income. Income almost $188,000. But his income really went up. So as far as calculating how much he's eligible for in disability benefits, that really increased the amount he's eligible for. But his employer added a group disability plan. So any group disability plan benefits are subtracted from the amount that he's eligible for from an individual policy. So in 2018, the insurance company came up with a calculation that said based on $187,000 of income, he's eligible for X benefits. If we subtract the group benefits he has, plus all of his existing benefits, he's eligible for Y amount. It was a little more than $500, but in 2018, he just decided to go with the $500 in additional benefits. So again, added $500 to the base benefits, reduced the future income pool by $500 a month. 2021, his income is now $351,000. Should have been an executive recruiter. Income's $351,000. So what did he do here? Exercised all of the remaining future increase pool. So as of 2021, he has $10,000 of monthly disability benefits if he were to become disabled on personal disability plan, plus his group disability benefits that are 60% to $12,000 a month that are employer paid. So as of right now, we used that FIO rider to add lots of different Legos to that one policy over time to get him from $3,550 to $10,000 a month. Financial underwriting, no medical underwriting. And all of his options were on those policy anniversaries, so sort of static dates. But they don't have to be on those dates. There's other times where the insurance company realizes that somebody's needs have changed and have some more fluid times when you can exercise your increase options either early or what they call off anniversary. So normally those options are only offered on the policy anniversary. You purchase your policy July 1st, usually your option comes, you get a letter on June 1st. You normally can't just do it in October if you wanted to. With these exceptions. There's an exception if someone has an increase of income of more than 50%. Now, I'd like to say that happens to people all the time. Doesn't, but there's certain occupations where it will. And if you think of doctors, when they're residents or fellows, not making near as much. Once they start move to their first full-time job, many times their income increases is double or triple. So Anthony was 40 and he just finished his fellowship. He had a $5,000 a month policy he took out when his income was $90,000. It's actually probably a little high, but most insurance companies have what they call new professional programs that say for certain occupations, again, like physicians, we're able to offer $5,000 a month, almost regardless of what your income is, because we're going to base it not off what your income is as a resident or fellow, but what the average is going to be for your particular specialty when you started that first practice. He had a $5,000 policy, $10,000 future increase pool. And insurance companies know what they're doing because when he started his first job, his starting salary was $360,000. So what do? because of that increase of more than 50%, which it's like a 400%, able to exercise that additional $10,000 of monthly benefits on an off anniversary increase. So once he started the new job, was able to turn his $5,000 a month into $15,000 a month. Again, no health underwriting. So that's the first kind of one of the off anniversary increases. So if your clients have disability coverage and you're doing policy reviews and somebody says, I'm making a lot more money this year than I was last year, here are times when they might be able to increase their benefits. Income goes up or disability coverage goes down. Loss of group disability coverage. So all of a sudden, maybe somebody's making the same amount of money, but instead of having that group coverage that the insurance company based how much coverage somebody's eligible for, they lost that group disability base coverage. Judith, age 40, she was working for the federal government, so she had the FERS disability benefits. And so over the course of time, we'd helped add $3,000 a month to supplement the FERS program for her benefits. So what happened? After a little while, she started in the private sector. So she started a private sector job and had a raise. So income went up. Same time, any sort of group disability benefits went down. They were lost. So no longer covered under FERS. So her policy had a future increase option. So because she lost her group disability coverage, we were able to add another $3,400 in monthly benefits on an off anniversary increase, $6,400 per month on her personal policy. So just another time, those two off anniversary when your clients lose group disability benefits or have an increase in income that's really high. Thank you everybody for tuning in, and just about to hit my time. So thank you again for tuning in. We'll see a number of you at conferences later in this year. But for those of you who are new to our LIS webinars, have a few things that we think that makes us different, and one of those are these webinars. In October, we have one disability insurance. November, if you're planning the future with long-term care, and December 13th, insurance mistakes to avoid in the new year. And I'll be doing that one again in December. So kind of fun to talk about mistakes. So what do? We work with fee-only advisors. That's all. And we help advisors save time and help clients save money by doing a lot of pre-underwriting. And I didn't touch on that much here, but pre-underwriting is, we kind of talked about that with Dr. White. Looking at somebody's health, all their different things they have going on, and trying to find the best fit for them. Best insurance company, best type of policy. And sometimes that might be that there's keeping the existing policy is the best thing to do. We have specialists in life insurance, disability, long-term care, annuities, and hybrids. So those are hybrids or joint long-term care life policies or joint long-term care annuity policies. We're proud sponsors of a number of different fee-only planning organizations and really enjoy working with fee-only advisors who have clients' best interests at heart. Alice is our advisor portal, so you can get updates anytime, anywhere. So anytime you're up at 2 a.m. in the morning, 2 a.m. and wanted to check on insurance, she's there. And I didn't have that many questions, but I had a couple. I was saving this one to the end. The Allstate Mayhem guy actually died for 2 minutes and was revived, lost some toes and a thumb. So how would his life insurance policy coordinate with temporary death? Would there be a prorated benefit paid? You know, I like this idea. I'm gonna guess that no prorated death benefit. It's gonna be an all or nothing kind of thing. But I actually do like that question. So thank you so much for that. And I see I've hit my time. And thank you everybody for tuning in. and we'll do this again in December. And I hope everybody has a great rest of your day. Thanks.